Hmm. 5, 4, 3, 2, 1.
Well, thanks so much for tuning in to Talking Point. I'm your host, Niraj Shah, and multiple things impacting both sentiment and trade in the near term. More so, some unexpected occurrings happening. So people always account for the known risks. What about the tail risks? Have they been accounted for adequately? And if indeed so, what about the near to the medium term? Wherein how does India do versus vis-a-vis the rest of the world, and what within India could do well and what could not? So lots of questions to our guest today. Needs no introduction really. Mihir Vora joins in right now on the show to talk about his thoughts. Mihir, so good to have you. Hope all is well.
Absolutely. Good morning. Thank you so much for having me.
No, the pleasure is ours, Mihir. Mihir, before we get to a few key talking points, can I ask you if you believe that there is any major tail risk that the street may have not accounted for, what might be playing out? I mean, the ever given issue seems to be sorted for the time being, but there's also the Archegos issue that came up day before yesterday, and which has impacted sentiment in the global markets, and the geopolitics always stays alive. Is there something that you think could become a potential tail risk over the course of the next 3 to 6 months?
Sure. Uh, when we began the year, if you saw the global fund manager surveys and investor sentiment, it was still in favor of commodities, reflation, stimulus, those kind of trades. Uh, at that time, the base case was that COVID will go down in a so to say disciplined way, and we should be having vaccinations in the world in a reasonable period of time. So both these things stand, except for the fact that we do see resurgence of COVID in Brazil, in India, in some of the European countries. So that's I would not say it's a tail risk, but it's a emerging risk. So to say, it was known the possibility of a second wave was always there. But the good thing is that it's happening along with the rollout of vaccination. So at some time in the next few months, both should cancel each other out, and we should be back to normal. If at all there is a tail risk, is I would say it's inflation and bond yields. Both are linked. And if you look at inflation expectations, because of the massive size of stimulus that the US and European governments are talking about, and US is going to further add potentially to that stimulus, we are seeing a huge run in commodities, not only metals but also things like lumber, edible oils, food products. Real estate anyway has been going up in any case. So if you look at any inflation expectation gauge, it's now running at 5 to 7 year to 10-year highs. And that is also leading to the bond yields, especially the US bond yields appreciating, going up. And you do see the US dollar going up. So there is a thin line between a healthy going up of the US bond yields and a unhealthy. So if the bond yields are spiking up because of sudden rise in inflation and inflation expectations, that would be a cause for concern. That would be a tail risk. But bond yields need to normalize, and if it's an orderly up move, then I think it should not be a tail risk. It's something which is healthy. So this is what the market is grappling with at this point in time, and I would say that is one tail risk that one needs to monitor.
Okay. Since we spoke about bonds, etc., just before we get down to the main topic, can I ask you for your view on what do you think happens to Indian yields and Indian bonds? There is also this news, and I would wonder if you want to dwell upon it for a bit, because it became a bit of an interactive point wherein FTSE Russell has placed the Indian and the Saudi Arabian government bond markets for possible inclusion in the emerging government bond index. There is a lot of talk around developments of these nature happening over the course of the next 3 to 5 years. How important this particular thing? How material is it? And how do you see the shape of things over the course of the next couple of years for this?
So it's a gradual progression, I would say, and this is something that the government is also quite keen on and has been actively working, if you realize, since the last budget. So not only do we have the FTSE benchmarks, but we also have the JPM benchmark and the Bloomberg benchmarks. And I think They may not all happen at the same time, but it's a process. And most of those benchmarks have a certain amount of AUM, which is passively linked to it. So we should see some good flows coming into India. Structurally, I don't think the numbers will be so great as to impact bond yields permanently for India. But one also needs to understand that it also, foreign capital in the government fixed income markets and even the corporate bond markets also then tends to bring in that amount of scrutiny and discipline. And to some extent, it can also be hot money. So it can work both ways. But as long as we keep the fiscal discipline, as long as we keep the current account, and balance of payments discipline, it's a healthy, inclusion. It's a healthy development because it only brings down the cost of capital, which is what we desperately want in any case.
Okay, so let's try and put this whole thing into perspective. How do you reckon India will do vis-a-vis rest of the world? Are you more bullish on the prospects of the Indian markets vis-a-vis the global markets, or could it be otherwise? And in both the scenarios, what could be the contrarian factors at play?
Sure. So let's talk about the economy. Markets have a life of their own, but let's take two time frames. One is the next 6 months or 12 months or so, and then we talk about the 3 to 5 year scenario. I think if you look at the 3 to 5 year scenario, clearly the structural changes that the government is making, in terms of policy, in terms of the PLI scheme, labor reforms, land reforms, import duties in a lot of segments, all are coming together to make sure that we have a resurgence of manufacturing in the country. So I think 3 to 5 years, I'm quite sure that India will do much better than the rest of the world. In the next 6 months, I would say probably the Indian growth may be a bit lesser than the global because of the sheer size of the stimulus that the US and Europe have done, and to some extent China and Japan also. And China and Japan actually have gone out of the COVID wave in any case, so they are pretty much well on track for normalization. We are still, kind of stumbling along because of this second wave one, and the stimulus that we have done is obviously not as much as what we have seen in the US. In the US, we are talking about 10%, 15% kind of a number, which is unprecedented, unseen, and you can see it in the euphoria out there in terms of consumptions, etc. So in the next 6 months, I think the global recovery, especially the US and China, etc., will be faster. But for the next 3 to 5 years, I think India is a better structural story.
And it is never necessary that markets and economy go hand in hand. So uh, even if the economic growth over 6 months, India lags, can markets do otherwise? Part one. And follow up is, eventually, if the Indian economy does come back with a bang, which a lot of people believe FY22 could be a year. I mean, we have nobody less than N. Chandra saying that we could have double-digit growth, albeit from a low base, but it could move ahead in FY23 as well. Will the markets necessarily follow suit me here with the economic growth, or can the markets lag due to a variety of factors?
Uh, the markets are actually, factoring a lot of that in already, isn't it? We are talking about valuations which are much higher than the averages, pretty much close to all-time high valuations, at least if you look at the aggregate Nifty levels. So to that extent, the market is expecting this kind of growth to come through. I'm not saying that the markets will come down because of this, but definitely this expectation, this hope is there in the market. And if we deliver, then you can see some very good, stock picking opportunities in different sectors.
Okay. Can I ask you, me, which side of the camp are you on? What maybe used to be a minority is now almost a consensus that money will be made by rotating out of higher valued, uh, maybe discretionary or tech companies or some of those globally and in India into manufacturing. I mean, we've heard that because we hear so much about India for the last 3 months, but in the US side as well now, everybody's talking about that, and we see NASDAQ duly follow suit, so to say. Where are you on this argument?
So, I think there is a bit of a misnomer as far as tech in India is, understood. Just because Nasdaq is going up or down doesn't mean that we go up and down along with the Nasdaq. We should not. Some stocks would, of course, especially the stocks which are, say, internet linked or consumer facing, but those are a small minority in the market cap in India, whereas they are much larger out there, the Facebooks and the Amazons of the world, which are big consumer facing companies. We don't have big consumer facing companies in the technology space in India. Though some of them are going bigger. So our IT services segment is basically catering to corporate America, not to the consumption America. So as long as the corporate sector in the US is doing well, as long as their expansion plans and growth plans are in place, I think Indian IT services will continue to grow. I don't think we have to be, worried about what happens to Amazon or Zoom or something like that, or Tesla for that matter, because we're not. Our IT services demand doesn't depend necessarily on that. We are depending on the normal corporate America, the banks, banking and financial services, manufacturing companies, and your telecom companies spending, and we do see that happening. So I think our tech is much more predictable, much less volatile, I would say, compared to the Nasdaq companies that are going up and down in a crazy fashion.
And I take it by that answer, Mihir, that you are constructive on Indian tech.
Absolutely.
Okay. The other big talking point, I mean, if let the part two of my question, which is manufacturing and manufacturing construction led. Now, again, I'm presuming that you might be bullish there. One, because of the valuation comfort that might be there, but two, also because of the government's doings, right? I mean, on the construction side, the whole push being given, and therefore on the manufacturing side as well, with the whole advent of the PLI schemes, the one for air conditioners might be out soon as well, and that's become the talking point now. What's your sense about what kind of benefits from an investor perspective would this PLI schemes have in the few sectors that they have been rolled out?
Sure. So first of all, let's be very clear. No country in the world has grown for long periods of time, or in high single digits or double digits for that matter, without creating physical infrastructure and without creating manufacturing capacity. All the miracles that we have seen in Asia, first it was Japan, and then we saw Korea, then the Asian tigers, and then China. All of them have been built on huge infrastructure creation, huge real estate expansion, and huge manufacturing capacity. Most of them have achieved their growth rates through exports and creating infrastructure to support those manufacturing exports, so to say. So the PLI scheme is basically trying to replicate that model over the long term. So not only capex in terms of manufacturing plants and equipment, etc., but a lot of ancillary work, a lot of say water treatment plants or waste management, cogen units, automation equipment. A lot of those segments can be positively impacted. Second is infrastructure creation, and that is a function of both the private sector to a lesser extent, but the government, and which the government has said for the next 3 to 4 years, we're going to spend the fiscal deficit on creating infrastructure, both at the central and state levels. So in this broad infra plus construction plus capex theme is what is going to drive GDP growth for the next few years. And I think that without that, there is no India story. And I'm quite convinced that these are the segments to be in the next 3 to 5 years.
There are some luminaries who have pointed out that what PLI might do is create artificial barriers and make Indian manufacturing uncompetitive. I mean, also immediately post PLI benefits being taken off, these companies will not be able to compete on the global arena with the global counterparts. And by the way, there are proponents of the move who are saying that it has to start somewhere, and if it starts off with these benefits being given, so that the companies can achieve scale, which will eventually help them get the economies and able to compete on the global side, then it is more than welcome. Again, because you may have studied this in detail, do you reckon that you would be comfortable buying into companies which are getting the PLI benefits right now, but they will get taken off in 5 years' time, and then you don't know what will happen to the company? So if you are, one, are you bullish out there in those spaces, the handset manufacturers, AC manufacturers, what have you? And two, would you invest in them tactically, wherein you might invest into them right now, take stock of it 3.5 years down the line when the benefits are about to be taken off, and or are you comfortable investing into them for the next 5 to 10 years?
Look, first on the question of barriers, the whole world is creating barriers, and the whole world has had barriers, whether we realize it or not. China has, even if you look at China, for example, it pretty much insists that any MNC setting up shop in China has to have a local partner. Isn't that a barrier? China has been manipulating its currency forever. Isn't that a barrier, visible or invisible? Most of the countries, developed or or emerging countries, have non-tariff barriers. They make it difficult for registration. They come out with complex, rules and regulations, local standards, etc. So even the non-tariff barriers, the invisible barriers are always there. So I don't think what India is doing is anything different from what the rest of the world is doing first. And whatever we are doing is WTO compliant. We've removed some of the earlier provisions which were kind of on the edge as far as WTO compliance is concerned. But the PLI scheme is pretty much WTO compliant. So there's nothing that we are doing which is out of whack or not in sync with good global political and business practices, so to say. So let's set that aside. We need this for the country. Everybody's doing it, and we need to reduce the fiscal deficit, the trade deficit, and create jobs in India. That's the priority, and I think we are pretty much on our way to do it. So that leaves it apart. And as far as the theme is concerned, the fact that the government has now come up with a scheme which is now very easy to administer. Earlier, there used to be always the scope for the gray area and manipulating it and gold plating it, etc. But now this is pretty much transparent, production link, scale link, so to say, and easy to administer. And there are clear targets, very well defined, transparent process. And the biggest positive is that they are selecting the larger players who already have scale and capacity to implement these things. Uh, if you look at all the approvals, they are coming to the larger players existing in that particular segment, whether it's electronics or mobile manufacturing, AC or auto components or chemicals and pharmaceuticals. It's going to establish large players who can definitely execute this. So the probability of success in this is quite high, and I don't see any issue in allowing a few global giants to get created in India. Korea has done it. It created the Kaiballs. China has created its massive manufacturers and large companies. So there's no harm in India doing the same. So I would really look at this as a structural opportunity, not only in mobile phones and electronics, but across wherever there is PLI, wherever we see the large players putting in capacity. I think it's a structural theme.
So you would be comfortable buying them not just from a tactical perspective, but if the opportunity is right, then investing to them from a thought process as of now that the companies might be competitive even post the PLI benefits being taken off.
They will be. They are competitive now, and with scale, they'll be even more competitive.
Okay, perfect. Thanks. The other big theme that, of course, emerged a few years back, Mihir, but now is becoming a big conversation point is ESG. Now, how do you? I mean, would you explain this a bit for us? Because a lot of companies are taking measures within the business that they are doing to be ESG compliant, and then, of course, there is a set of businesses which are in the business which is kind of ESG compliant, so to say, right? And green energy, for example. So how do you see this becoming a mainstream central investment theme? And would you reckon that a larger part of global funds might move into the entire business being an ESG dominant business, or would companies, for example, in the chemical space, which are adhering to the global ESG standards, also stand to benefit from them? I'm using chemicals as an example, but it could be pharma, it could be power, it could be various other things.
Yeah. So, ESG as a theme is gaining momentum with the climate change and the way things are being run, and also questions on business practices of certain countries which are kind of polluting their way and growing, so to say. So those questions are being raised, and now that 20-30 years have passed for this manufacturing boom in Asia, etc., people are becoming more aware of this. So I think a lot of the initiatives has started from the Western sovereign funds, but now it's percolating down to the normal mutual funds, pension funds, and the institutional investors. And now even at the retail level, there is growing awareness that we need to do the right thing the right way, so to say. So I think that concept of socially responsible corporates is definitely gaining ground. The way it is the way it's getting executed is still not very clear. So, for example, some funds have taken the call that we won't invest in anything which is to do with say coal manufacturing or anything to do with tobacco Some investors are drawing a bit more fine line as to trying to see the net impact of what the company is doing, so to say. So it's an evolving space. There are no very clear cut guidelines, and what I have seen is that ultimately, if a company is good in G, the ENS are typically also falling in place, unless the sector itself is polluting. That's a different matter. But we did a quick check on our own portfolio, for example, and what we found is that 80-90% of our portfolio is already in the kind of ESG compliant, ESG high score kind of companies, because we always have paid good weight. We always have put a good amount of weightage on the governance part of it. So a good governing company will try to be energy efficient. Will try to make sure that all the pollution norms, etc., are kind of there. They'll have an illustrious board, and board members obviously will say, okay, what's the net impact of our company on the social environment? So those kind of in good well-governed companies, that awareness is already much higher than a not so well-governed company. So I would think that with the global exposure of Indian corporates and boards, this trend will continue. But it can have fringe benefits for certain companies which are again in the process of pollution control equipment, or water waste treatment, those kind of things. Yeah.
Yeah, and there are a few of them starting to come up in a big way. Okay, me last couple of questions. One of them is on the conundrum currently on metals, wherein the sell side seems to be extremely bullish, and people who are buying are now not looking at companies which on a valuation metric are trading at levels, or the valuation levels that they were trading at, maybe say June to August or September last year, when the metals were trading at the nadir, so to say, on a historical basis. Now they've gone up quite a bit too. Are you still comfortable investing in commodity names, if at all? And do you reckon that it's a lot less cyclical this time around? I was listening to an interview that the Steel Secchi gave to one of the brokerages, and it seemed that the hints are coming that it may be a lot less cyclical than what it has been in the past. Do you buy that argument?
For commodities, I never take a structural call. It's always a tactical call, frankly speaking.
Okay.
And especially with commodity, unless it's lithium or something where there is only a few countries producing, supply is tightly controlled, etc., or cobalt for that matter. Things like aluminum, steel, copper, these are huge metals, multiple manufacturing countries and locations. What we have seen is that a lot of the disruption in global supply chains has caused some of the squeezes in some of the metals. Maybe partly it is structural. I don't know. Some capacities might have gone out permanently. But in commodities, you can never be sure, especially in these large commodities. So while we have been buying commodities, etc., it's never with a 5-year view, frankly speaking.
Got it. Okay, my final question. We have retreated a bit from the highs, so to say, 6-7% lower, at least 7% as of last count, and then today we may have gained a little bit. And some of the macro factors like crude, etc., have also cooled off a little bit. My question to you is, if you had the option of being in cash a little at the current juncture, looking at everything from a start of FY22 perspective, would you want to be a bit on cash, waiting tactically for lower levels because you believe they might come? Or would you believe that you would want to be fully invested because the earnings growth, etc., and the economic growth might carry all boats along with?
So we are a bit on cash as
Okay.
of now. Not so much because of anything else, but because of these couple of tail risks that are emerging. The second COVID wave in India. That there is unfortunately again chatter of some kind of lockdown, etc., potential in some parts of the country.
You think that will have an impact on markets, Mihir, if indeed sporadic lockdowns come up?
It would, right? Because see, my biggest fear is not that 1 day, 5 day, 1 week, 1 month of production loss, which can be managed somehow. We did it last time. We can do it again. But if again this labor exodus starts, that's a problem. We should not, we should not see this panic by the poor laborers last time, because remember what happened was they were locked up and not allowed to go out of the cities for a long time, and then one fine day they just say, okay, we are going to start walking and go home. That panic should not happen. I'm just worried a bit about that. That's a tail risk. I don't think it's a very immediate risk, but since we are talking about tail risk, that is one. And second is this huge spike in inflation expectations globally. So that is happening as we speak, and it's already begun to impact bond yields. US bond yield as we speak has already touched the previous high of 1.74. So that is one tail risk that I'm kind of a bit worried about. So these couple of things make us sit a bit on cash as of now, and we'll use the opportunity if we get some chance.
Got it. Mihir, lovely talking to you. Thank you so much for your time, and thanks for explaining some of the points in detail. Really good having you, and stay safe, most importantly.
You too. Thanks for having me. Take care.
Our pleasure was ours, Mihir. And viewers, thanks for tuning into this edition of The Talking Point.